Welcome, and thank you for joining our Driving Forward Post-Pandemic and Political Unrest discussion today. My name is Kendall Rawls. I am the Director of Development for the Rawls Group and your host for today's panel. We have received many great questions from each of you, so we're going to dive in fast to ensure we get to them all. Before we begin, I'd like to introduce our panel. First, we have Kevin Gilbreth. Kevin is a tax partner within the Retail Dealership Tax Specialty Group at Crow. His work is focused on large multi-point dealership groups. He has extensive experience in tax consulting issues, including transactional and corporate structuring, captive insurance consulting, and business planning. Next, we have Hugh Roberts. As a succession planner with the Rawls Group, Hugh Roberts leverages his more than 4 decades of experience to facilitate the resolution of issues that must be addressed by business owners and their families in order to preserve assets and develop succession plans for their organizations. And last but not least, we have David Weaver. As a succession planner with the Rawls Group, David focuses his work with owners and management teams specializing in strategic planning, business performance, management synergy, and teamwork. He helps identify areas that affect performance and culture, transforming managers into effective leaders. Again, thank you all of you who submitted your questions. For those of you who may have just joined us, please feel free to use the Q&A feature, the Zoom feature throughout this time to ask any additional questions that you may have. And with that, we are going to get started. So the first question, Kevin, I'm going to gear this one towards you. What's the general outlook on the Biden administration tax policies, and how soon can we expect changes in the estate tax laws?
Well, thanks for the question and opportunity to be on the webinar today. That is a great question and one I'm hearing a lot. None of us really knows for sure how all of these policies, if any of them will become laws, how they will take their path through Capitol Hill, but we know kind of what the wish list is. And stepping back and looking overall at what that wish list is, I think it generally is a policy of shifting more tax burden on taxpayers who make more than $400,000 a year, or taxpayers who have estates worth more than $5 million a year, and then shifting some of that revenue down to lower income tax bracket people for things like additional deductions, child tax credits, and earned income credits, and that sort of thing. And so I expect any final policy that we see put up there to try to create laws from is going to have that general theme behind it. And I know we're focusing more on estate taxes today, and I think as far as timing and effectiveness, I think you could see a lot of activity this year on Capitol Hill in relation to estate tax. And possibly we could see something even before they touch some of the major income tax items. Now, more likely than not, it'll be all part of one massive bill, but historically, estate taxes and estate tax increases are somewhat easier to get votes on because it's less politically unpopular than raising taxes just generally across the board on all income taxpayers in a certain bracket. And there's reasons for that. If you look at the statistics, last year, 2020, now these are just estimates from the IRS. They don't finalize these for another year, but there were only 1,900 estate tax returns filed that actually paid tax. So if you think about that, that's only 1,900 taxpayers out of 328 million. That's less than 0.001% of the population that an estate tax increase could possibly affect. And so that's where I'm a bit pessimistic that they're going to struggle to get increases passed. I kind of fall more on the side that we should really plan for some of these increases to actually get votes on, because it's much less politically unpopular to vote for an estate tax increase than it is other types of tax increases. The other reality is, and one of the arguments against it, or too much changes to the estate tax, is it doesn't really raise that much revenue for the Treasury. We're talking about 16 billion in tax revenue last year versus 3.71 trillion in overall Treasury revenue. So that's less than 0.5% of the total budget. So there's not, even if they do make a major change to estate taxes, such as cutting the lifetime exemption in half, taxing appreciation on property at death, a number of other things that we'll probably talk about today, it's unlikely it's going to raise all that much revenue. And because of that, it doesn't, when economists really analyze the effect of an estate tax increase, it really has very little, if any, downward effect on the economy because of the type of tax it is. And that's where I'm a bit pessimistic that we're gonna stay the course, and more on the side that I think we will see estate tax increases, is because not only is it's not as politically unpopular, but it also has very little effect on the economy, according to past studies by the Congressional Budget Office. So with that, I'd say the soonest we could see it, in my opinion, is the worst case scenario is they make it retroactive back to January 1st, 2021. Now, I think that's unlikely, and historically they haven't done that sort of thing, but it could happen. The next date that it could happen is maybe by the third quarter of this year, they could vote on a law and make the estate tax effective as of the date that it's signed. But I think the most likely, and where I don't have a crystal ball, but if I did, it would probably be telling me that January 1st, 2022 is the most likely date that they would make an estate tax increase effective. And I think probably we'll see something effective by that date.
I was just going to add to that. I agree with what Kevin's saying, that the fact that the COVID crisis has created so much tremendous debt, they're going to be looking for quote unquote easy ways to try and raise some money. And even though this doesn't allot the political momentum on that, I think you have to plan as if it's going to happen.
I agree. And I think to a certain extent, it's more about optics than capturing more taxes. Despite the high tax rate, Kevin, already indicated how little federal revenue it brings in. But, I just think it's kind of a way to send a message that the administration is, in some people's eyes, going after the wealthy, who can be seen by some as receiving unfair tax advantages. Now, whether that's true or not, whether you believe in that or not, I think sometimes it's just about political optics. But I would also agree with the timeframes as well. Third quarter probably at the earliest, and more than likely probably first of next year.
The other thing I didn't think to mention, kind of popped into my head, was it also aligns with, we know that the Democratic Party is in control of Capitol Hill right now, and they have the votes. Part of the estate tax accomplishes one of their major platforms of some Democratic lawmakers, which is minimizing a concentration of wealth. And estate tax basically goes after that goal of, by removing a big part of that wealth transfer from one generation to the next through estate taxes, or through poor estate tax planning. Let me say that. And that's the other reason why I think it could come up more likely than not this year in some voting.
So I would just add that this makes it very critical that whatever time we've got, it's a fairly short period of time to do any significant estate tax planning. And now's the time. The sooner you get on it, the better.
Right.
Thank you. Okay, another question. This is for David. David, is the stepped up in basis in jeopardy?
Well, stepped up basis provides obviously big benefit to those who inherit certain assets, including real estate, and it means that the person who inherited the asset only has to pay tax on its gain in value beginning from the time that it was inherited rather than from the time it was originally purchased. So President Biden is proposing eliminating the stepped up basis for individuals, and as Kevin indicated, targeted towards individuals with incomes over $400,000. So let's say your father purchased a property 30 years ago, which you inherit. That property could have easily doubled in value, if not substantially more. And that represents a significant gain. And that would then be realized when you sell the property. So if the step up in basis is eliminated, then you'd be responsible for the capital gains tax on that full increase in value. So you've got short-term gains, which are properties held for 1 year or less. That's taxed as ordinary income. More than likely, you would be hit with long-term gains, keeping those assets longer than 1 year. And that's taxed either at 0%, 15%, or 20%, depending on your filing status. So the maximum capital gain, and then there's also a qualified dividend rate, but would be 20% plus potential net investment income tax of 3.8. So you could pay as much as 23.8%. But I would say, yes, that's definitely something that the administration has identified that they would be going after.
That's one that I think could become very politically unpopular because once they start running the numbers of we're eliminating the stepped up basis at death, and for those assets, let's say the patriarch or matriarch of the family has built this asset with no basis, but has built tremendous wealth in this asset if it's an operating business. And then all of a sudden they have to pay capital gains on that accumulation of value. If you think about, let's say, just a goodwill in a really well-performing dealership that builds 10 million of value but no basis, you're talking about taxing that at 23.8% and then applying an estate tax on top of that of 45% of what they're proposing now. The beneficiaries or the next generation is left with well under 50% of the value, which just seems unfair. And maybe I'm wrong. Maybe it won't get picked up as a politically unpopular thing. Maybe I'm just hopeful it won't happen, but it's very, very punitive if they get it passed.
Well, it isn't. It's not just the large investors, that are participating in this. You could not have great wealth, but still inherit property. Of course, again, depending on your income, it may or may not, have much effect on you, but it's something that might not necessarily be targeted at the very upper end of wealth categories.
It's my understanding, going back even before my time, and I've been doing this a long time, that they attempted to do this very thing in the past. And I think Kevin was right. When you started seeing the implications of it, it lost momentum and they backed off of it. But who knows?
Thank you. And for those who have just joined us, just a reminder that if you have a question that you would like answered as a result of the conversation happening, please feel free to use either the chat option or the question and answer feature in Zoom. So the next question, this is geared towards Hugh. Hugh, how likely will the exemption go down?
I'd say 100%. The real question is when and how much. Basically, what we have right now is the current law is the estate tax is scheduled to go back to 2017 levels as of the end of 2025. So from a pragmatic standpoint, think of it as cutting it basically in half. We're currently at $11.7 million per individual, and it's likely with the increases, et cetera, to be somewhere in the $6 million range. So just think of it as cutting it in half. But then there's always the possibility of change of law that could happen, as Kevin was pointing out earlier, anytime. With a Democratic controlled Congress, and a desire on the part to move in this area, I think it's, he pointed out, it could happen at any time. So I think it becomes critically important, since this could happen at any time, if you are desirous of taking advantage of the exemption that you have right now, which is the highest it's ever been at $11.7 million per person. So as a couple, you're talking, 23 million plus. Right now is the time you need to be talking to your advisors. Right now is the time you need to be taking steps, because the very nature of making asset transfers becomes something that takes time. You need to get appraisals. You need to think through the implications. You have to do the legal work, the accounting work. I mean, there's just a lot involved in doing this. And the longer you wait, less likely you're going to be able to take advantage of it before they do change the law.
Yeah, I think with certainly if they do nothing, it will be reduced anyway, as you indicated, Hugh. So I'll take that bet at 100%.
Yeah, that's a great point. They don't have to pass any laws whatsoever. They just have to wait and let the current law take effect in 2025, and it still goes down.
Mm-hmm.
Yeah, so if you think in terms of that, since we have the only way that it would likely change would be literally to have a Republican president, a Republican House, and a Republican Senate. And since that's not going to happen within this time frame, everybody can sit on their hands and it will be cut in half. And they can say, well, I didn't have anything to do with it. I didn't vote for it. It just happened. And, so a person who wants to be politically cautious or whatever, that's what they'll do. On the other hand, now that the Democrats are in office, they are much more likely to say, we want to do something. And now it's just a question of when they will and when they will make it effective. So I'd say you absolutely need to move as quickly as you possibly can if your desire is to get full use of the exemption. And I think we'll be talking a little bit more about how can I use it. But for now, I think that answers that question.
Thank you. We just got one from the field, as we'll call it. Kevin, I'll gear this one towards you. What are the thoughts on the interplay between Biden's proposed capital gains rate increase and the elimination of step-up and basis?
That's a great question and brings up a great point that one of the many Biden administration kind of wish lists for tax policy change is to remove the preferred tax rate of 20% on long-term capital gains and apply the ordinary rate. The ordinary rate right now tops out at 37%, but they would like to make the law change to put it back to 39.6%, which is where it was back in 2017. So with almost doubling the capital gains rate, and then if, let's say, they were successful in passing a law to take away the step up in basis, you're talking a very punitive combination of laws happening all at once that, I was talking before about, let's say you've got that $10 million asset with no basis because you created the goodwill yourself to pass down to your family and the business. All of a sudden that gets taxed at 39.6%. And then after that, after you subtract those taxes, whatever's left over gets taxed at 45%. Yeah, your beneficiary is basically left with little to nothing. They would be forced into a position where they'd almost have to liquidate and sell the company to somebody else just to pay the tax bill and be left with a little bit of cash. So yeah, it's, I guess going back to the question, the interplay, it's a very negative result if those two pass at the same time.
Yeah, and just speaking of numbers, Kevin, I think Biden's tax proposals are estimated to increase revenue by something like $4 trillion between 2021 and 2030, if they remained in effect. But it's also estimated that 93% of those tax increases would be borne by taxpayers in the top 20% of households by income. But the top 1% of households, which is really, what we're talking about, are going to be affected by a lot of these changes, would pay 3/4 of the tax hike. So that should tell you something right there.
It's one more reason to do your planning now, if you haven't already done it.
Yeah.
Another follow-up question to the one I just asked. Given the net worth of many senators, this comes from the field too, wouldn't somebody oppose to this?
Certainly, there are some that are going to vote based on their own personal tax situations. So there is some light that you might not get enough votes to get this passed. However, what we know about tax policy is that it doesn't require 60 votes in the Senate. They can get it done through the budget reconciliation process, and they only need 51 votes to do that. And we know that one party, the Democratic Party, has 51 votes right now to get it done if they wanted to. So that's a great point. It might flip. Just if it flips just one person in the Senate, then it wouldn't pass. But I'm not hopeful. I'm a bit pessimistic.
I was also going to say that to some degree, when they changed the exemption and moved it up to the current $11.7 million, that really was a game changer in terms of lowering the percentage of people who are subject to federal estate taxes. So in the past, I think when we were down with a combined couple of, say, 10 million or something like that, it was much more likely to be the effect. The fact we've now got it up to $23+ million for a married couple means that even at the Senate or House level, there's probably a lot less people who are falling into that category. So I'm inclined to agree with Kevin. I'm still dubious about that changing the game.
Unfortunately, many Americans can be counted on, I think, for one thing, which is spending their money. A majority of Americans, as soon as the money hits their account, they find somewhere to spend it, and they don't pass 20 million plus on to their beneficiaries. So it just doesn't hit a lot of people.
Mm-hmm.
Okay, Kevin, thank you. If I use up my lifetime exemption available at the current levels and the exemption is cut in half by legislation this year, will they retroactively go back to gifts already made and make me pay gift tax on amounts above the lower level?
So fortunately, no. The IRS several years ago passed a special anti-clawback rule for cases just like this, where we have this 23 million of combined exemption that we know is going to get cut in half, either with law change or just through sunset date. So it's in Reg Section 20.2010-1. And it basically says, if you've already gifted and you've already filed that gift tax return using the lifetime exemptions available at that time, if a law changes or if it sunsets to go to a smaller lifetime exemption, they will not go back and change the previous gift tax return filed, that those exemptions at that date still apply, which is one more reason. You'll hear us say this probably a dozen times a day. If you haven't used up your lifetime exemption at the current levels of that almost 23 million for a couple, now is the time to do it, because this anti-clawback rule allows you to go ahead and use that before the law changes.
I think one of the other things that it points out is, most people say, well, I want to take advantage of every tax break I can. At the same time, you say 23 million between my wife and I really don't feel comfortable passing $23 million to my children. Isn't there anything else that I could do? And I think this is what brings into play a spousal lifetime access trust, that if you've not considered, and you're in that situation, I think it speaks very directly to that need. The essence of a spousal lifetime access trust is that one spouse is going to pass assets to the other spouse in an irrevocable trust that makes those assets totally available to their spouse for the rest of their lives. And then upon their death, it will pass on to the beneficiaries, likely to be the children in most situations. There are rules regarding making sure that the two trusts are not quote unquote reciprocal. Reciprocal trust doctrine applies, which basically means they can't be the same type of trust. But there are many, many ways to work around that to allow you to set up two trusts and make gifts from the wife to the husband and from the husband to the wife that will allow you to use your exemption and to lock that in once and for all, and yet to still have the use of those assets during your lifetime. And I think that is a planning tool that, if you have not considered, makes a lot of sense in a lot of situations. Must, again, deal with your tax advisors to make sure that you're doing it in a correct fashion.
Well, the other thing maybe to consider is that, all these topics that we're talking about, they're political footballs, right? And while some of them last for many, many years, at some point, there will be other administrations that come in. There will be most likely changes in voting structure, in the House and the Senate. So, while it may go down now, it may go up in the future as far as these exemptions. So I think just as important is being able to meet with your advisors and and I think Hugh kind of hit on it, is, what is your comfort level? Because while there are other structures that we could put in place to perhaps accomplish some of the same things, there's also just the general long-term planning of your future and guaranteeing your future income and not changing your lifestyle and things of that nature. So there has to be a little bit of give and take on that, I think.
And also, you made a great point there, David. If you go back to roughly the last 30 plus years, politically, our country has, every time we vote, has basically a kick the bums out approach. And we've been swinging back and forth between parties, literally in a sweep fashion, where one party sweeps the other one out of office, and either 4 years or 8 years later, we turn right around and do it in the other direction. So there has been some massive going back and forth between which party is in control at the time, and I don't see that changing.
Thank you, Hugh. David, is there any chance that Biden's tax plan could become retroactive in 1/1/21?
I think we addressed a good bit of that, because I think it would apply to any of these tax changes, and that most likely not. I mean, the last time we saw a significant tax increase, for example, that was enacted retroactively, it was in August of '93 with the omnibus budget bill. And that increased the top estate tax rate from 50 to 55%. And they did make it retroactive to January 1st of that year. But Kevin brought up a good point in that some of these tax changes don't really affect the economy so much. So it perhaps would be easier to get those passed. But as a general rule of general tax changes, unemployment's still high. We're still in slow recovery, economic recovery from COVID-19. So probably just not an ideal time to deal with significant tax increases. So I would say more than likely, as a general rule, we would look at changes effective more January 1st, 2022 going forward, which gives us more time to react to this and plan for this. But as Hugh noted, and Kevin as well, we really do need to dig in now and do that planning.
Thank you. Kevin, if I waited until 2021 to start gifting, does that hurt me compared to gifting in 2020?
Well, we don't know for sure. I'd say my personal feeling is that probably not, but you have less time now and less certainty now than you did last year. because there is some small risk of retroactive change, but also we have less time because we know that some tax law increases that have passed have been made effective on the date that they were signed in the very middle of the year for things like estate tax. While unlikely, I'd say you have to have that mindset that, okay, no new tax laws have passed yet. You have less time to get it done. And as noted by my colleagues here, there's so many steps in that process. You've got sometimes to get valuations done. You need to get the lawyers involved. You need to get your tax counsel involved. All of those things take time. And I can guarantee you, just because we have valuation experts that I work with and I have partners, they have valuation people out there are more busy than they've been in years. And so just getting on their schedule is important right now so that you don't run out of time. So it doesn't necessarily hurt you, but now is the time. If you do think you need to make changes, go ahead and get that process started.
Amen.
Agreed.
Thank you. Kevin, another one for you. How can Biden's proposed policies impact reinsurance programs?
That's a good question. It really depends a lot on how the reinsurance program is set up. And I'd say very popular in the dealership world, a very good profit tool for the dealerships to utilize, and also has been a good estate tax tool. If the reinsurance program is set up, you had good advisors, it's set up in a way that you're actually putting your next generation in ownership before you even start seeding that very first insurance policy. It's possible that none of these estate tax changes will have any effect whatsoever on that reinsurance arrangement because you haven't actually gifted anything. You've put your next generation in ownership while that company had zero value. And then all of that future appreciation and growth as more and more insurance contracts are seeded, as they start to turn profit and build up and move through their life cycle, all of that wealth is accumulated at the next generation, and you never had to file a single gift tax return. So I'd say a well-structured reinsurance arrangement that you intentionally set up with estate tax planning in mind, possibly there's no changes. But I will say that if, let's say you're trying to gift or you gifted reinsurance interest to a type of trust, a grantor trust or something like that, that eventually you were going to pass down to the next generation because you just weren't ready to give that kind of wealth control. Possibly some of the proposed estate tax changes could affect that. So I'd say there's two questions you got to ask is how did we structure this? Is some of it owned by a trust? Was some of it passed down through gift tax planning? And if so, let's go back and reanalyze and see if there's anything at risk, because there are proposals out there, which I think will be difficult to pass, but there's some Democratic proposals that want to eliminate the effectiveness of grantor trust. And in that case, if you had your reinsurance arrangement in a grantor trust, there might be some problems.
Thank you. Hugh, how does a business owner decide if staying in the game is for them or if they should exit?
Great question. I think bottom line is you have to recognize that this decision is going to affect an awful lot of people, starting with you. And the first big question is that we would ask somebody who is raising that question is, why do you want to get out? This is being raised in this question, in this time is usually, well, it's an uncertain future. There's a whole bunch of reasons why I'm nervous about it. And if you truly have decided I'm tired of this business, I want out, or I don't want to incur the risks that I see, and I want to take my chips off the table, then I totally understand that. But we deal with a lot of people who say, well, I'm going to try and time the market or something like that. And they really haven't dealt with the impact that it's going to have on their own lives. What am I going to do? We find an awful lot of people turning right around and going right back into the business that they said that they were going to get out of. The impact on their family, the impact on their community, their their employees, all those things come into play. So one of the questions becomes, how important is maximizing value? And the first thought is, well, if I sell today and get this high number, then that's the most I could ever get. Well, that's not necessarily true, because obviously you got to take the after-tax number and compare that. You also have to look at the kind of numbers that you're pulling out of the business in terms of your lifestyle, et cetera, and all of a sudden have to replace that with your own dollars. And then for many people, they will look at, well, maybe I want to sell over time, and they might be in a position where they can sell to people within their own organization, et cetera. And you need to run those numbers, because I remember distinctly what one client said a number of years ago, pretty well summed it up. He said, if I took the number today and that I'm being offered for my business and compare it to 10 years from now, and I'm just going to make the comparison that for the next 10 years, I will make half of the profit that I've been averaging over that period of time. And in 10 years from now, I'm going to sell for half the number that I was being offered today. Where am I at? And the truth was he was going to end up with more money in his pocket by having kept it for the next 10 years. And for him, more importantly, he said, I really wasn't ready to sell. I wasn't ready to get out. And the combination of those two factors said stay in for now. So obviously an individual decision, but a lot of factors that you need to consider.
Yeah, it's great, Hugh. And I think so many of the clients that you and I work with, they just love the business. It's in their blood. And the last thing they want to do is get out. But they're very quick to point out that if one of the publics came in and offered just a stupid offer, it'd be kind of difficult to ignore that. But there's so much to consider here. And again, we can't let taxation issues be the sole driver of decisions. We view the decisions, more through the eyes of succession planning, and the sale of a business is a valid succession option. But I think it depends a lot on, availability, goals, and drive of the next generation. If you have anybody queued up, anybody that has a love for the business and wants to be a successor candidate, whether you wish to sustain a family business legacy in what you believe is the future of your industry, regardless of what that industry may be. Businesses and industries are constantly in flux, as are tax laws, as we've previously said. So I would just encourage everybody, as I think Hugh has pointed out, is to take the long-term view.
Thank you, David. And I've noticed there's been a few more people who've joined us. So welcome, and just want to encourage you that if you do have a specific question, please use the Q&A feature that Zoom provides, or you can send it to me in a chat. All right, so we have another one from the group. David, if staying in the game is a good time to diversify or get more focused on where you are?
That's a great question. Diversification is always an option, and it's a great way to hedge uncertainty, which we certainly have plenty of right now in any market, whether that be the stock market or the market within your particular business or geographic area or other consideration, I guess. Each provides its own unique issues that I think should be considered. Most business owners, I think, like to stay within their own wheelhouse. It's a business they know and love and feel they have some sense of control over, whether they actually do or not. Many times we're trying to get owners to build up assets outside of their business so that they won't be as tied to the business when it comes time to turn it over, hopefully to the next generation. And they have difficulty with that because they're like, well, then it's out of my control. It's just up to the market. So I think a strategic planning session would be a great exercise, kind of, pragmatically review strengths and weaknesses of your business, your industry, your markets, financial conditions, all the above. And that would probably provide you with, more informed view of current future conditions that you might want to take into account for a decision. Breaking out into areas that you might not be comfortable with certainly is more risky. than buckling down and really focusing on maximizing results within your current business. And a lot of times that's what we're doing, is saying there's so much left on the table here. Focus on the business that you have, because you can very easily, maybe even double the profits that you have. I think we get caught up in languishing and just becoming comfortable where we are. Auto dealerships, for example, the future of their industry, they're going to be affected down the road by increased electrification of vehicles. It could substantially reduce income from maintenance and repairs. Some are worried about next generation of buyers, relying on ride sharing and less on vehicle ownership. I think to that audience, I'd say these changes are coming some number of years down the road, and there'll still be millions of vehicles out there that need service. But I feel your apprehension, and it's certainly a worthwhile discussion and exercise to review your options. So I think, in summary, certainly a way to hedge on risk, to diversify, but also I just see so many businesses that get caught up in what they're comfortable with and used to, that they kind of forget what it's like sometimes to really challenge themselves.
I'm just going to add one thing to it. What you said about building some diversification outside the business. If all your assets are tied to the business, from a succession standpoint, it's very hard for you to turn that over to your successor and not just cling on and hang on to it, et cetera. But if you build a nest egg, whether it's in real estate or in other investments or stock and bond portfolio, whatever it might be, that puts you in a position where you can release the baton and allow your successors to continue to run the business with a lot less tension and strife, usually at the family level.
Absolutely.
Thank you. Hugh, how can one best keep the message to their team current while setting future expectations in this seemingly unknown environment?
Well, we are in an unknown environment, probably more so than any of us has experienced in a long time. Obviously, change has come upon us very, very quickly. Interestingly, we've seen particularly the automotive industry do extremely well under this, which says the industry is full of a lot of people who are really good at making adjustments and changes. And usually it's been my experience, whether entrepreneurs are good at that, regardless of the industry you're in, that ability to flex with the circumstances and make the changes necessary. Clearly, business is all about what are you doing today and doing it well and repeating it over and over and over again. And so that focus needs to stay out there. At the same time, you need to cast the vision. You got to make sure that your people understand why you're doing what you're doing and where you hope to go. And I think more than at any time under these trying conditions where families are dealing with all kinds of issues at home and at work, et cetera, you need to be very much a motivator and recognizing people and trying to be as in touch with your people and their needs and so forth, because they may be vastly different than you as an owner. But boy, they need a pat on the back probably more than ever under these conditions.
Yeah, they say today's has its own problems, and don't spend too much time on tomorrow. Seems like every CFO that I talk to these days that cut off all their used vehicle purchasing or tried to get rid of their used vehicles back in April are kicking themselves now and wish they had done the opposite because they missed out on some profit. So a good measure of humility about ability to predict the future is always good.
Thank you. David, how can one get started on succession strategies and tax strategies and estate planning strategies during an environment of so many unknowns?
Well, we live in a world of unknowns, don't we? And I think the precursor of how can we get started is when do we get started? So many business owners we talk to just put it off because, well, I think for one thing, it deals with their ultimate demise. And that's a subject that nobody really likes to tackle. But let's remember that succession will take place whether you're ready or not. And question is, do you want to be in control of that process, or will you allow yourself and your business, your team, your family, and others to be subjected to a lack of preparation? I was with a family just yesterday who was talking about an owner within their industry whose family's battling over a sizable estate due to a lack of planning. And we firmly believe that there's no family gain or no business gain worth a family loss. And a lack of planning certainly can subject you to those types of issues, and can permanently divide a family, could cause financial losses, and at the extreme, actually the loss of a business. So how do you get started? All right. Well, I think just acknowledging that you want to tackle this difficult subject really is a great start. You'll most likely need guidance on the process. But the first step is talking amongst your partners if you're not an individual owner, or your family, if a family-owned business, and discuss expectations of each other and the future of the business beyond the current ownership. You may or may not have successors in mind, and that will certainly drive the discussion and options. And whether you engage our services or not isn't the point. We can certainly have a discussion with you, though, and help you evaluate current circumstances. Our goal really is education first, and hopefully then you can determine your direction and how to get started on next steps. But that will absolutely include talking with your CPA, your estate planning attorney, your business attorney, and other advisors that you have come to rely on over the life of your business and your personal circumstances. So that might be one way to get started.
We were just hired by a 50-year-old who asked, the first question he asked was, am I too young to start? And I said, no, absolutely not. Succession planning is all about today. And we have a tendency to think it's something that only occurs when we hand the baton over to the next generation. But it's really about building the strongest organization you can have today so that you can withstand whatever life's challenges get thrown at you tomorrow. So the sooner you get on it and begin a plan, the better position you're going to be in, the stronger your company is going to be in, the better your family is going to be prepared, and the more likely succession is going to take place.
I have a client in that same age group, and the question of age and is this the right time? And he and his wife said, we're really more concerned about our legacy at this point. And I was so taken by that, to have the maturity and the forethought to think about, what comes after us. And I applaud that kind of thinking.
Thank you. Hugh, are there any specific tax planning or succession strategies you recommend currently?
Well, I touched on those earlier. There's all kinds of ways to transfer wealth to avoid estate taxes, and intentionally defective grantor trusts, often called IJIT, are used extensively to transfer wealth, and that involves basically a combination of gift and sale, and is a highly effective way of transferring wealth and using up a small amount of your gift exemption. I already mentioned the Spousal Lifetime Access Trust, which again, for those who are not willing to transfer assets over to your children today for whatever reason, might be willing to transfer it to their spouse. And then, there's all kinds of ways to put assets into a vehicle, such as an LLC, a trust, or whatever, which will allow you to stay in control of the asset, but move the equity over. We often use recapitalizing the stock into voting and non-voting, again, to allow you to move equity to your kids and to put it into a position where you stay in control and your kids don't get their hands on the actual assets until you're ready for them to get it at an appropriate time. So these are challenging and very sophisticated ideas that need to be carefully thought through in terms of their tax ramifications, their people ramifications, the family in particular, and the business. All of those things have to be taken into consideration. You don't want the tax tail to wag the dog.
I agree. At the same time, I think we talked about do do I take advantage of the full exemption right now? And am I ready to transfer that amount of wealth or that kind of wealth? But I think one of the things that I'm hearing questions about right now is, do we at least take some kind of hedging strategy? And that I think absolutely makes sense, because none of us have the crystal ball, as we've all readily admitted. So hedging with some tax strategy and through some of these vehicles, although they're permanent in nature, we can certainly get started with those.
Yeah, and I mean, the sky's the limit on all kinds of estate tax planning that you can do. And it should be unique to the person's family, the person's situation, and just what they want to achieve for their legacy. One of the recent ones that's being used a lot, because we don't know where the estate and gift tax exemption will end up, is a formula-based gift that attorneys will write into the gifting document that you're gifting this much value, and which is equal to the remainder of the taxpayer's remaining estate tax exemption. So technically speaking, you could have your estate tax attorney help you craft a document that says you're going to gift whatever's remaining. And even if they made a law retroactive, you wouldn't be in trouble of getting into a tax paying situation, because the gift would just revert before you file the gift tax return to exactly what you had left. So there's tons of just great ideas out there, very smart estate tax attorneys. But there's no lack of ideas that's going to work for your unique situation.
Most importantly, we can't emphasize it enough, the sooner the better. You think back to the example of 50-year-olds or even younger. One of the clients I've worked with now for over 25 years was in his mid 40s when we first started, and we've been able to move millions of dollars at critical times, taking advantage of what the cycles of the economy, et cetera, when values were down, utilizing exemptions, using a variety of tools, and what we've basically done is chip away at it and taking bites of the watermelon, rather than it be 75 or 80 years old and trying to swallow the watermelon all at one time. So the sooner the better.
Great, thank you. David, what insight do you have for leaders working to keep morale up and drive performance under our current circumstances?
Well, I guess the elephant in the room as far as circumstances go is the COVID-19 virus. It just hit all of us. I won't say out of nowhere, but certainly was much, much larger and affected us much greater than we ever would have imagined. Like it or not, how you may have handled the virus initially in early 2020 really set the stage for keeping morale high and giving reassurances that, that you could all get through this successfully. But regardless of whether you laid off employees or not, much of the message was in how that was handled. I have some clients who continue to pay employees at full pay and didn't cut back staffing, even though it hurt their profitability. Now, if you owned a gym or a restaurant or a similar business, you really didn't have any choice, because at some point you were given governmental mandates to close down. But regardless, I think communication is really the key. As a lack of communication, it really just feeds the development of rumors to fill the void. And those are rarely positive, as we know. So even in the face of uncertainty, you can confirm that you'll evaluate all the current information and act in the best interest of everyone involved. You just have to make decisions sometimes, whether you know that they're right or not. Continue to have, one of those rare opportunities to show great leadership in the face of uncertainty. How many politicians do we know have wasted such an opportunity, whether at the national or local level? And that's not calling out one party or another, because, everybody's, been bad at that. So we see what happens, and that's typically distrust and disinformation, which we don't want. So the best thing, I think, is don't falter, communicate regularly, keep a positive attitude that others can follow. And then what we can do, one of the things is to make sure everybody's on board with exceeding customer service expectations. COVID's drawn so many of us back into our homes where we have a lack of interaction with people. And this is just a great opportunity to show them how far we're willing to go to gain their business and retain their business, whether it be deliveries or pickups or online ordering or just ensuring a clean environment. And again, motivating managers and employees to go above and beyond expectations during these times. I'd also consider recognition of the efforts of your team members who may be having problems and illnesses at the family level, and they're all going through their own issues. I think we all appreciate recognition in some way, and that can go a long way in keeping everyone motivated and driving for that extra bit of performance.
I just think you emphasized a key point there, is that people right now feel very disconnected for lots of reasons, and they're whether or not they've got children at home that are not able to be in school, and that's putting enormous pressure on the family situation. And then that man or woman coming to work for you is dealing with their fears and worries about what's going on at home. Whether or not they've lost a loved one. I just got an email or a text, I'm sorry, just before this meeting of one of my friends' father had died. That person, when they go to work tomorrow, is suffering from that. So the more you can connect with your people, this is a time to reach out to them any way you can. They will never forget the fact that you were there for them during this time of crisis.
Thank you. Hugh, beyond taxes, what do I need to address in order to make sure my business continues through the next generation?
Well, we've been spending a lot of time on tax today, and it's a critical factor in the succession planning, et cetera. But beyond that, I think people do tend to focus from a succession standpoint on wills, trusts, and taxes, and think that if I've addressed those things, I'm in good shape. But there's a whole host of things that would involve building an exit strategy. How are you going to get out? How are we going to work that transition between me and the successor? Are we prepared for that? Have we dealt with credit continuity with the banks? And all of a sudden the banks, which have been depending on, on the owner's financial strength, and that person's gone, they may be in a position where they've got demand notes that all of a sudden are going to get called. You better make sure those are in shape. To the extent we're dealing with manufacturers, making sure there's manufacturer approval in writing for everything that you want to happen from a succession standpoint. Your management team, are they in alignment with your succession plan? Do they know what it is? Are they willing to go with that? Are they willing to follow the successor? The last thing you need to hear is what one manager, the COO of a very large organization, said 8 seconds after Junior is in charge, I'm out of here. So thank you very much. That's not going to work. You've got to have your profitability at a very high level if you want to have succession. You have a strategic plan. We find that auto dealers in particular are very good at forecasting, not so good at strategic planning. Is there a plan? Because basically change is going to happen, is what succession is all about. And if you want to be able to deal with change adequately and effectively, you've got to have a strategic plan that you're working. Is that successor ready to take over tomorrow? And if not, what are you doing to prepare that person to take over? And in between, if something should happen to you, do you have a succession bridge in place? And that's a formal plan, an individual, a group of individuals, whatever, that are going to be able to carry that business from now into the future. And I have been driven for the last 40 years by the motivation of having dealt with a client who I just started in the business, and this particular individual was at the peak. He was the owner of one of the largest companies in their particular industry, and died suddenly. And I met with the and had not addressed the planning. And I met with the widow 9 months later, and she said to me, "Well, I'm sure you have a lot of good ideas, but I'm probably no longer big enough to be your client." And I said, "How do you know? How do you even know what size my clients are?" She says, "I don't. But all I know is that I'm about to sell out to our biggest competitor for a fraction of what my husband would have told you it was worth." I reached into my briefcase and I pulled up a piece of paper with the number on it that her husband had told me the company was worth, and she was selling for 1/12 the value. The bottom line was that the competitor had basically at the funeral practically had grabbed their general manager, who was, he and the owner were the keys to this major organization, and they stole them away, made an offer too good to be true. And as a result, that family was no longer in the business. To me, setting up a plan so that never happens again became a huge factor in what we're all about. And then family dynamics, if we're not dealing with those issues, if we're not getting in there and helping a family to communicate, et cetera, all too often that can be, the thing that drives the business into failure. So all of those things are critical.
I would agree with all of that. And especially coming from the tax person, I just want to add on, don't make the saving every penny of taxes the number one goal. That's part of the plan, and you want to retain as much value for your next generation as possible. But more important than that is the right plan for you, even if it costs a few more tax dollars. And everyone that I've seen succeed or fail had one core principle, which was communication. How good was the communication before, and how good were they monitoring and staying on top of that communication with the family, with their professionals, adapting to the laws as they changed? Was the communication there year after year? Because if you ignore it and don't do anything until it's too late, you could end up not achieving the legacy that you wanted.
Thank you. And we're getting close to or actually a little bit over the 1 hour. So we're going to go to our final question. Kevin, what are your final thoughts from this, just to sum up conversation?
So good question. So much of what we've covered so many points. From my perspective, I'm the tax guy. I'll talk about that. What we know is there's a strong possibility that estate taxes are going to change as a result of some sort of legislation this year. We can't guarantee it, but we think they will. Some of those changes include greater than 50% reduction to the lifetime exemption that you can use for gift and estate. They're talking about taxing unrealized gain on appreciated property at death. There's a proposal to raise the estate tax to 45%. There's one proposal to remove the ability to use lack of control and lack of marketability discounts when gifting things like minority interest in partnerships or corporations. And then there's also talk of almost doubling the long-term capital gains rate. But all of that centers around what we know is that the pendulum is swinging, and it's swinging towards a tax increase of some kind. And the final thought that I want to leave from the tax side of this conversation is, now is the time to really evaluate your estate tax plan and strategy, talk to your professionals, look at these proposals, and does your plan hold up against these, or do you need to make some changes or adapt to what's coming? Maybe not, but communication with your professionals, with your family, and just don't be caught surprised when things do change.
And I think what everybody wants to know is what's going to happen. What can I expect? And the one thing we do know is that uncertainty is a given. We've seen it many times before with everything from changes in administrations, policies, laws, tax laws. We've also seen it with things like natural disasters that interrupted supply chains, economic downturns, recessions. We've seen it with natural changes in consumer habits that change the way they do business and, with the way they buy products and services. And now we're seeing some combination with many of those, especially with COVID-19. So change is inevitable. We can only focus on what we can control and what we can plan for. So I would just leave you with this, that I think proactive planning along with contingency plans for what we don't know is to come all can help us deal with both the present and the future.
And I would simply say that our clients are people who are extremely busy, love what they do, and have great intentions when it comes to all the things we've discussed today, but often say, what I need is someone who will push me. One guy said, I'll tell you what you are, you're my friendly pain in the butt. If you weren't friendly, I'd kick you out. If you weren't a pain, I'd never get this done, because quite frankly, I don't want to deal with it. And this is a guy who very much wants it to be dealt with, wants it to be done right, but it's so easy to just kick the can down the road. The sooner you deal with this, the more likely that you will be in control, your objectives will happen, your business can continue the way you want it to, and you can dictate what will happen into the future.
Thank you. Thank you to all of you guys who attended and participated in this discussion with your questions. Again, if you have any additional questions, please feel free to reach out to Kevin, Hugh, David, or myself. Their email addresses are on the screen. We will circulate this recorded conversation within 48 hours. And I hope you all have a wonderful rest of your day. Thank you so much. Goodbye.
Take care.
Thank you.